Dividend was largely what we expected in terms of just a bump in returns to shareholders.
Well, that's right. All a reflection of how well the banks are recovering after those bumper numbers as well in Q1. It is perhaps a reflection of how the economy in Singapore is recovering after billions of dollars were spent by the government to lift the country out of that deep, deep recession. Let's take you through some of the numbers. OCBC, this is the number 2 lender here in the Lion City. Net income up 59% year-on-year, dividend of 25 cents per share versus 15.9 back in Q1. For UOB, second quarter net income coming in at 1 billion Sing dollars. That's up 43% year-on-year. Dividend payout ratio of about 50%. Again, a reflection of how strong the liquidity position is. That is also adding to, I guess, reasoning why the MAS lifted the dividend cap payout, which it imposed about a year ago, to just 60%, a reflection of how well the banks are recovering right now.
No wonder we have seen those gains in bank stocks, among the best performers on the STI this year. But I wonder if a lot of those positive news have already been priced in.
Well, if you take a look at what analysts are saying, perhaps not. I mean, in fact, some of those analysts tracking OCBC shares, they're expecting the shares to go up as high as 15%. That's quite a long way up from here. Overall, year to date, they're up about 20%, outperforming the STI, which is up about 10%, doubling the share price of compared to the STI's performance year to date. So, again, a reflection of how well the banks are expected to recover. Bear in mind, though, there are risks. I mean, we heard from the IMF saying there is an uneven recovery when it comes to the economy. Asia, in particular, at risk, like Indonesia, Malaysia, where these banks have exposure to, and even North Asia, China, which was leading the recovery, benefiting the likes of OCBC. It is now showing signs of a pandemic taking hold again, the Delta variant back again in focus. That may be a risk for these banks.